First off, I just want to welcome everybody today. Thank you for joining for our tax planning webinar. My name is Angela Reddick, and on behalf of Sensiba, we're excited to spend the next hour walking through some of the most important tax updates. First off, I do want to let you know we are providing CPE credit for this webinar. So to receive the CPE, you'll need to answer all three polling questions that are sent today. You do not need to answer the polls correctly to get credit, although they are fairly generic, so I think you'll be fine. But for full credit, you also must attend at least 50 minutes of the webinar. So this session is being recorded, and a copy of the slides, along with a link to the recording, will be sent out to all attendees. Um, First off, at Sensiba, I just want to give a quick overview of our firm. Tammy, if you'd like to move to the next slide, thank you. We've been serving clients for more than 40 years, supporting over 10,000 businesses and individuals across the US and internationally. Our work spans tax, audit, sustainability, consulting, and governance risk and compliance services. So we're proud to combine deep technical expertise with a people first approach. So delivering timely guidance, practical insights, and solutions that help our clients navigate change with confidence. Now, I'm thrilled to introduce our speakers for today. First off, we have Tammy Arnold, Senior Tax Manager. Tammy has more than 24 years of experience specializing in business taxation and accounting consulting for small and mid-sized businesses. She also teaches at local universities and is deeply involved in community service. You'll hear from her shortly as she walks us through key planning considerations. We also have Tim Tukalski, tax principal. Tim has more than 40 years of experience advising closely held companies, partnerships, and fiduciaries. He leads our real estate and construction tax group and is well known for his work in valuations, cost segregation, performance management, and succession planning. He'll be sharing key insights on bonus depreciation, Section 179, and real estate related planning strategies. We also have Kaylin Kleinhans, state and local tax practice leader. Kaylin leads our Sensiba's SALT practice and brings 15 years of experience in multi-state income tax, nexus evaluations, and complex state and local compliance. She works extensively with clients in technology, retail, and manufacturing, making her the perfect person to cover our SALT deduction changes today. And lastly, we have Cole Marr, tax partner. Cole has over 20 years of experience helping companies across technology, biotech, and manufacturing identify and substantiate research tax credits. He's frequently quoted in national publications and brings a strong blend of technical expertise and practical insights to today's topics. So, with that, we do have a full agenda, so I will now turn it over to Tammy Arnold, who will walk us through what we'll be covering today.
Again, thank you and welcome to everybody. Today we're going to be doing an overview of Public Law 119-21, known as the Big Beautiful Bill, or as we'll refer to it as the OBBBA provision. It was enacted on July 4th, 2025. This legislation fundamentally reshaped the tax landscape for both individuals and businesses by making many of temporary TCJA provisions permanent or extended. For individuals, OBBA introduced new reliefs, deductions, and credits aimed to benefiting working families, seniors, and those saving for the future. For businesses, the changes enhanced provisions related to 100% bonus depreciation and Section 179. In addition to restoring some immediate expensing of domestic R&D expenditures. Up front, I need to do a few disclosures. First of all, the information provided today is based on current guidance. Please note that this legislation is evolving and additional updates are expected, and we're hoping we'll get those before tax season. This presentation covers some key federal provisions under OBBA, as noted in this agenda. We recommend, though, that you consult with your tax professional and, if necessary, your legal or financial advisors regarding how these provisions apply to your specific tax situation. And especially if it is if the state conforms where you are residing or operating your business. Please note that some of these provisions have an effective date, so definitely be mindful of those dates as you're implementing maybe some tax strategies, as these may occur maybe in 25 or 26 or sometime in 25. Our team will be moving quickly through this material to hopefully allow us or anticipate some time for us to have to address some questions. However, if we cannot address your questions during the session, our contact information will be included in the slides that will be emailed to you after this presentation, as Angela has indicated. So without further ado, I'm going to turn this over to Tim Tokowski. Tim will be reviewing some common estate and tax planning techniques. Tim?
Thank you, Tammy, and thank you everyone for attending. So again, my name is Tim Tukalski. I'm a CPA and have been practicing for actually 45 years. I just celebrated my 45th tax season this year. I also, as Tammy, am an adjunct professor, or was at Cal State East Bay for about 8 years. And one of my topics presentation was estate gifts and trust. Although I will admit I am not an expert in this area, I do have enough knowledge to be dangerous. I also have been around for a very long time, 45 years, so I have experienced the changes in the estate gift area, which was primarily an increase in the federal estate exemption amount. So as you can see from the slide, probably one of the biggest changes brought on by the OBBBA was eliminating the decrease in the federal estate tax exemption. So back in 2017, the exemption actually went up to, I believe it was 11 million adjusted for inflation. So now we had settled on an exemption amount of 13.99, almost 14 million of exemption per person in 2025. That, however, without the changes in the OBBA, was scheduled to go back to the pre-2018 exemption amount, which was roughly 5 million adjusted for inflation. So I think that the math would have settled on around 6 million per person. We've never experienced a decrease in the exemption amount, and thankfully we're not going to have to in this round of legislation. But what I believe it does is it sends a message to people that estate planning is very critical, especially now if you are have an estate that is equal to or close to 15 million or 30 million per couple. What I think is interesting about this legislation is what is not included in the bill. So what was debated was actually, as I said, a decrease in the exemption amount. But there was also a debate on whether or not on death there would be a stepped up basis in the assets. So I think that many of us who have engaged in estate planning know that with the bad news in death, there's good news, which comes with a fresh basis in the assets that are distributed to beneficiaries. And again, that was hotly debated in this particular act and thankfully did not pass. Something else that has been bantied around in Congress and the IRS, in fact, in 2016, the IRS proposed regulations which would eliminate the ability to take discounts on gifts, so valuation discounts. And so those are kind of two wake-up calls, I think, for us and our clients to say, look, even though it is probably business as usual as far as estate planning, we should do it with some urgency, not as much urgency as there would have been had the exemption gone back down to 6 million. But I think the strategy is still to review your estate plans, consider making gifts early on, especially gifts of appreciating property with particularly high basis, since, on a gift not involving a death, you don't get a stepped up basis. So that is the kind of off play between, do I do a gift now, or do I wait and pass that through at death? So Tammy, if you could go to the next slide, just as a reminder, the exemption, which again will be $15 million, is not reduced by gifts if those annual gifts are less than $19,000 per individual. So gifting using the leverage of the annual exclusion is still a great strategy, and should be implemented. If you're anticipating a gift that exceeds the $19,000, you might want to consider splitting that gift between 2 years. So for instance, at the end of 2025, make a $19,000 gift and then make another gift beginning of 2026. If you go to the next slide, Tammy, we also have some, again, not much change. Oh, I'm sorry, with this one in particular, it just reminds us that the federal law is not necessarily covered by the states. So some states, while most do not have an estate or inheritance tax, there are still a few that do. So you need to seek the advice of your estate attorney, especially if you're a resident outside of California or own property outside of California. Next slide, please. So again, same as usual, I guess the status quo as far as estate planning. Time to, however, continue to review your existing estate plan to make sure that it is in line with not only your wishes, but your current family dynamic. So if there's been a recent death, if there's been a birth, grandchildren, if there's been a change in the value of your properties, I think it's important to sit down with your advisor and decide whether changes are needed. Just as a reminder, and we could spend a whole hour just talking about these, but kind of the common techniques for estate planning and gifting are revocable living trusts. Those don't do much for reducing estate taxes, but what they do is eliminate or control, I want to say probate fees associated with this, and actually acts as a living trust or a living will that makes the wishes of the decedent clear in its distributions. Irrevocable trusts, on the other hand, are again used to remove assets from an estate, again, especially if they're appreciating in value. And those are a great technique for reducing your estate tax and still maintaining some control over the assets as they go to the decedents, or what I want to say, the donees, right? The descendants. Go to the next slide, please. And if you're charitably inclined, there's always an opportunity to give away your property through various methods, primarily maybe a trust, a charitable remainder trust. And let's not forget about generation skipping. If you decide to skip your current generation, your children, and go to your children's children, there will be taxes associated with that. And then the last three, again, the reminder of the annual exclusion amount, family limited partnership, which is a technique to transfer and take advantage of those fractional interest gifts, primarily in real estate, which I alluded to earlier. Congress is tinkering around with that. And then intentionally defective grantor trusts, which are an ability to, for estate tax purposes, transfer assets, but not remove those assets for income tax purposes. So with that, I'm going to turn it back to Tammy, who I think will kick it over to Kaylin.
Great, thank you so much, Tim. Kaylin is going to be joining us. She's going to indicate or discuss with us how OBBBA impacted the SALT deduction for individual taxpayers, as well as address the pass-through entity tax election. Kaylin?
Thank you, Tammy. Hi, everyone. So first, we're going to talk about the SALT deduction limitation increase. OB3 has increased it from $10,000 to $40,000. And that is the itemized state tax deduction on your federal return. So it is not an adjustment on your state returns. This is applicable for tax years 2025 through 2029. And part of the rules that have come with this increase is that there is a phase out that is based on federal modified adjusted gross income. So most high earners are going to ultimately be subject to this phase out and reduce that $40,000 back down to $10,000, which is still going to be the allowed amount for high earners. So for married filing separate, we see this maxed out at $300,000 of modified adjusted gross income. And for all others, it's going to be $600,000. So while it sounds good on the surface, we're going to see a lot of high earners still be subject to that $10,000 limitation. And we're going to talk about some workarounds still to that. OB3 has also incorporated a planned 1% increase to both the deduction limit amount and the phase out threshold for modified adjusted gross income of 1% each year through 2029. So we will see these numbers adjust each year, but again, not material likely for most high earners. Next slide. So how can high earners work around this $10,000 limitation? It remains most beneficial to make a pass-through entity tax election. We're going to specifically talk about California today, but there are a number of other states that are, have pass-through entity tax regimes and are making rules to extend those regimes as a result of the passing of OB3. So for California specifically, we were due to sunset in 2025. It has now been extended to tax years 2026 through 2030. The mechanics of the pass-through entity tax for California remains consistent with pre-2026. So, the regime that we've been through since this was first introduced is consistent. It is a 9.3% tax rate on qualified net income on the shareholder member or partner's qualified net income, with the election being required to be made on a timely filed original return, including extensions. So that still is beneficial that the election is allowed to be made on an extended return. Additionally, we still have our required 2 installment payments. So the first being due June 15th, based on the greater of $1,000 or 50% of the prior year California pass-through entity tax liability, with the remaining amount due on the second installment, which is due on the original due date of the return without extension. So that is still going to generally be due in March and at 100%. The carry forward of the tax credit that the shareholder member or partner receives remains 5 years and non-refundable. So it is a use it or lose it within 5 years, and it is important to make sure that you're generating credits you can actually use. So what did change as a result of the pass-through entity tax being extended is California finally addressed one of our biggest pain points that taxpayers have experienced as a result of the pass-through entity tax, which is the possibility of inadvertently voiding the California pass-through entity tax election through a missed June 15th payment or an underpayment of the June 15th payment. We've previously experienced no exceptions, no safe harbor, no leeway from the FTB about these missed or underpaid June 15th payments. And so quite often we're seeing taxpayers, just inadvertently have these elections voided, which can be very, non-tax favorable for them. However, starting with tax year 2026, the state now, we have made some provisions so that taxpayers are not inadvertently voiding their elections. So the election is going to remain valid even if the 6/15 payment is missed or underpaid. However, as a result of an underpayment, the shareholder member or partner is going to receive what we're calling a penalty, but really what it is a reduction of the credit of 12.5% of their pro rata share of the underpaid amount. So it is important to consider this because it is not just you get to underpay and not have any sort of penalties. There will be a penalty and a reduction of that credit that you receive. Next slide. So SALT planning, what to keep in mind. Obviously, high earners are going to have little to no benefit as a result of the increase to the SALT deduction limitation. So high earning taxpayers will need to continue to consider the benefits of electing into state pass-through entity tax regimes, not just in their state of residency, but also potentially in states that you are filing a non-resident return as a workaround to that SALT deduction limitation. The other thing is cash flow needs versus California pass-through entity tax credit optimization. So having that June 15th payment requirement still be 50% of the prior year pass-through entity tax liability, it could be that June 15th payment significantly exceeds what you're expecting your California pass-through entity tax liability to be in the current year. So it may make sense to underpay that June 15th payment to hold back some cash and instead take that penalty on your credit that you receive as a result of the election. So something to talk about with your tax preparers and make sure that you are considering what the cash flow needs are versus the credit optimization.
Great. Thank you so much, Kaylin. For the next few slides, I will be addressing how OBBB has impacted depreciation, especially the 100% bonus depreciation in Section 179. And then finally, in this section, I will also have Tim kind of revisit with or come back and provide us some information and especially an impactful example on illustrating 1031 exchange and when that may or may not be advantage. So let's start off with bonus depreciation. Before OBBB, the bonus depreciation was scheduled to actually phase out over the next few years. We're looking at a 20% decrease each year, starting in 2023, with 80%, 24, 60%, 25, 40%, 26, 26, it was going to go down to 20%, and then ultimately phase out in 2027. After passage of this legislation, we see that now bonus depreciation is permanently restated or property placed in service after 1/19/2025. You may be questioning why that date. That was the inauguration date. So any assets placed in service after that date are now would be allowed to claim the 100% bonus depreciation. One thing I did want to indicate here is that bonus depreciation is not limited to your taxable income like we will discuss when we talk about 179. So this has become a very great advantage for a lot of our businesses. The type of eligible property has remained unchanged. And just to go over what type of property that would qualify for the 100% bonus depreciation, we're looking at property that has a maker's recovery period of 20 years or less. So mainly we're looking at assets that are typically classified in a 5, 7, or 15-year life. That would include furniture, fixtures, appliances, machinery, equipment, some interior lighting, flooring, covering, site improvements, which would be some of your landscaping, fencing, and paving. And then also qualified improvement property which is really, I think, something, oh, and one thing I did not indicate in here, which is important, would be vehicles too. So now going in, I'd like to discuss something that is sometimes not clarified with regards to bonus depreciation, and that is qualified improvement property. Qualified improvement property is made to the interior of a non-residential building after that building is first placed into service. These are mainly improvements that could either be made by the owner or the tenant, and these would not include the expanding of a building, the installation of an escalator or elevator, or the altering of an internal structure framework of the building. This is for those that are investing maybe in upgrading leased commercial properties. It really is potentially a great tax benefit for accelerating that depreciation. Again, this is one that you would have to, if you did not want to take bonus depreciation, you would have to elect out. And when you do elect out, that is for all the classes, with all of the assets within a particular class line. Going on to Section 179. Section 179 probably is not as impactful. It might have been, say, in the year 23 or 24 when bonus depreciation was decreasing. But it is still an option for companies to take advantage of. Prior to the passing of the legislation, the Section 179 deduction was at $1,000,000.22. And with a phase out for, ultimately this deduction would phase out if the total qualified property placed in service exceeded $3.05 million. Those limits have greatly increased for 2025. So now we're seeing you can have a Section 179 deduction up to $2.5 million. Again, there is a dollar for dollar limitation that for property that total property purchased and placed in service that exceed $4.5 million, and ultimately phasing out at $6.5 million for the year 2025. Again, I want to kind of emphasize the overall deduction for 179 cannot drive you into a loss. It is limited to taxable income. This is probably one of the disadvantages when comparing 179 to bonus. Bonus, you can create a loss. Section 179, you cannot create a loss. Again, the property that qualifies for 179 has not changed. You must, of course, own the property. It must be used in your business. It must have a determinable life, and that determinable life must be more than 1 year. And you must have more than 50% business use of that property. Just some planning strategies with regards to depreciation. Again, be aware of the effective date. This date of 1/19 for bonus depreciation is a little out there, so just make sure that you're, of course, taking that into consideration. You also may want to consider cost segregation studies. Now that bonus is 100%, we can look at doing a cost segregation study that would break down the cost of a building into certain components, such as that 5, 7, or 15-year life, in which you would qualify for bonus. You also want to be very cautious about pairing deductions and making sure that the impact of your accelerated depreciation takes into consideration if you have passive income or if you're a real estate professional, where you can really maximize the deduction. And if you had a misclassification of an asset in the prior year, again, or if you're doing a cost segregation study and you've noted that some of the assets in a purchase were misclassified, you can actually do a change of accounting method by filing the Form 115. And then, of course, finally, too, we also want to look at reviewing our economic unit election, where we may actually group a business that we have that we're also maybe renting the building in a separate entity. By grouping those together, which for purposes of passive loss activities, we can also offset the income and losses across that group. And so when we're taking depreciation, we may want to consider grouping. And finally, just some points to note. When you're doing your tax return, getting your tax return information together for your business, please make sure that you review your depreciation schedule. We know that we're talking about depreciation in this section, but understand reviewing that schedule will help you identify if you have any obsolete assets that might impact the idea of how much property insurance you have or how much property taxes you've paid. And you might be actually overpaying those if you are not removing obsolete assets. And finally, understand that what we're discussing here is for federal tax purposes. You do want to look at your state and see if they conform with these guidelines, as it may impact your state income tax liability. And so I'm going to go ahead and turn this over to Tim, who's going to give us some information on is Section 1031 the way to go. Oops, Tim, I think you're on mute.
Gee, how many years have we been doing Zoom? And I always make that mistake. I wanted to preface this discussion with, and it's going to be a very brief discussion. I want to give time for our other panelists. This is just an illustration of, I think, the complexities that goes into the analysis of whether or not to do a 1031 exchange. So in my experience, clients are very adverse to paying taxes, and their knee-jerk reaction is always, I'm selling a property and I'd like to do a 1031 exchange if they want to stay in the real estate game. And then I often ask that client, well, what is the tax consequences if you don't sell? I mean, if you do a 1031 exchange? And they usually say, well, I don't know. I just know I'm going to pay taxes. Well, don't you think it would be good to maybe sit down and analyze what those taxes are, and then, given the benefits of the cost segregation study that Tammy had mentioned earlier, maybe using some leverage in your purchase, actually recognizing the sale so that you get a stepped up basis in the property that you're replacing. If we could mathematically prove that you're at least equal to and maybe slightly better off selling the property, reinvesting the proceeds, albeit less tax, and getting a stepped up basis, would actually equal or exceed your benefit, why would you do a 1031 exchange? So again, I don't have time to go into extreme detail. You have the slides. I would offer that anyone considering a 1031 exchange would be happy to walk them through a similar analysis. But again, based on these facts, Tammy, if you can go to the next slide and see what entails this kind of analysis, and primarily the difference between the 1031 and the sell and buy scenario is the depreciation that you would receive on the replacement property. In a cash flow analysis, which this is illustrating, deductions that generate refunds are pretty much as good as cash flow in your pocket, assuming you can take the deduction. So notice that on the depreciation line for period one, in the sell buy scenario, we have a $254,000 depreciation deduction that, assuming taxpayer could take that, i.e. real estate professional, or maybe this property is being leased to their closely held business, that will result in a $79,000 tax refund or a reduction of taxes, again, on a federal basis. So, Tam, if you go to the next slide, a common technique that we use to compare options is what is the actual internal rate of return of that decision. And you can see under this scenario, they're very, very close. The after-tax return for the option of 1031 versus the sell and buy is, a couple of decimal points, or a couple of percentages. So given that scenario, why would you do a 1031 exchange? There are specific timelines you need to meet. There are going to be costs associated with the exchange. And you're not going to be able to get the benefits of the depreciation on the replacement property. So again, quick example, happy to help. This is the kind of thing that we do above and beyond the tax consequences. We also like to help our clients with the decision on what options are available to them. I'll turn it back to Tammy.
All right. Great. Thank you so much, Tim. I'm going to go ahead in the next few slides kind of delve back into itemized deductions, specifically how OBBB kind of impacted charitable donations. So first off, the top part is going to be about individuals. I'm going to touch bases real quick on C Corps, but pretty much for 2025, nothing has changed. You still have to itemize in order to do a charitable donation. And those charitable donations may be limited based on the type of donation it is, based on the percentage of your adjusted gross income. For 2026, though, we're going to see some major changes. One of those major changes would be only charitable donations amounts that exceed 0.5% of your AGI will be deductible. So we're going to have kind of a floor in place for 2026. In addition, for 26, if you are a taxpayer that does not itemize, you can actually take donations of $1,000 for single head of household and $2,000 for joint filers for cash donations only to public charities. That does exclude, of course, donor advisory funds. The 60% limitation on cash donations to a qualified organization was set to sunset in 2025. That has been now extended permanently to 2026. And then just I want to throw in there, because we're talking about itemized deductions with a SALT limitation and also charitable donations. We are now going to see that taxpayers in the 37% tax bracket will have an overall limitation on or cap on their itemized deductions. So just be aware that if you're falling into that tax bracket, some of your itemized deductions may be limited. I'm talking about individuals at the top, but I also want to throw in for C Corps, because this does apply to 2025. We are going to see a 1% floor on that, on charitable donations as well that are made by corporations. So charitable donations made by a corporation are now only deductible to the extent they exceed 0.1% of your corporate taxable income. And on top of that, we still have, it has been in existence, a limitation of 10% of taxable income. So for 2025, if you're going to have your C Corp do a donation, please note that you will first have a 1% limitation based on taxable income, and then overall, your charitable donations cannot exceed 10% of your taxable income. So just to kind of give you a background, again, all depending on the type of donations you make, there may be a percentage limit based on your GAAP. This mainly applies to, of course, cash, non-cash, and capital gain properties that you're donating. This has not changed under OBBB. So this is still in place, and I'll go ahead and kind of walk you through how this, to some extent, impacts the amount of the 0.5% as far as carryover. So again, we have only, you can only take donations that exceed your 0.5% of the AGI. Once that is applied, and that's done before you take in consideration the percentage limitations that we had on the previous page, we will go through then and see, well, is any of this amount that is disallowed because of the 0.5 AGI carried over? There's kind of three buckets that this falls in. Well, if I have allowable charitable donations below 0.5% of my AGI, there is no deduction and no carryover. How about if they exceed 0.5% of my AGI, but it does not exceed the category or the percentage caps that we've noted 2 slides back, like the 30 or 50% caps? There is no carryover of the disallowed amount. Well, what if we exceed, again, our 0.5% of AGI, but the overall donation also exceeds the percentage cap. You do have a carryover disallowed 0.5% amount, and it's a 5-year. I think probably what would help is to kind of go through some examples. So I have just 3 quick examples to kind of go through. One is if you have 2%, or if you have $200,000 in AGI, and you've made a $900 cash donation. First of all, we say, what is the floor? The floor is 0.5% of AGI, which is $1,000. Well, my charitable donations do not exceed $1,000. So I have no charitable donation, and I have no carryover. But what if in this case, maybe I don't itemize? In that case, if you don't itemize and you're in the year 2026, then you could take the standard deduction and you could take the $900 cash donation just on the front of the return. So wanted to make that aware. The next 2 examples, we're going to be at the same amount of AGI, which is $1 million. But in our first scenario, say we make a $200,000 cash donation, again, subject to a percentage limitation of 60%. My AGI, 5% of my AGI, the floor is $5,000. My 60% of AGI limitation is $600. I'm well below that. So in this case, I would get a charitable donation allowed of $1,950,000 of the $200 that I actually donated. And that $5,000 does not get carried over because it does not exceed the 60% of AGI. Same scenario, but I've made a $700,000 cash donation. Again, my floor is $5,000. My percentage limitation is still $600,000, but I'm going to be allowed a donation of $595,000. Taking again the limitation is $600,000 minus the $5,000 floor. What about that $5,000? What about the carryover amount? Do I get a carryover amount? Yes. In this case, I do get a carryover amount of the $100,000 that's related to the 60% limitation, and I do get a carryover of the $5,000 related to the floor. Once again, just kind of want to emphasize that I did not, in those 2 examples, take into consideration any itemized deduction cap for those taxpayers that may be in a 37% tax bracket. So what's the planning opportunity? Well, kind of the obvious one, make a donation in 25, because that is when you're going to get the more bang for your buck. I hate to say that, you don't want taxes to kind of drive donations, but if you want the max donation, you're going to be looking at doing that in 2025. Other things just to kind of keep into consideration, of course, be aware of the percentage limitations of both non-capital assets, which would be probably your inventory, clothing, vehicles, and then also your capital gain assets that you might be donating. Make sure to, of course, just basic information, keep the proper contemporaneous documents for your donations. Checks and credit card charges are not considered proper documentation. You do want to get a donation acknowledgement. And then one last thing, if you're over the age of 70 and a half, there is what's called a qualified charitable distribution. That is a distribution directly from your IRA to an eligible charity. And that kind of bypasses a lot of these floors that we're seeing. And for 25, you can make it up to approximately $105,000 and $108,000 for 2026. So with that said, I'm going to go ahead and transfer this over to Cole. He is going to be talking a little bit about the tax incentives of qualified small business stock, as well as the tax treatment of research and development expenses under the OBBB.
Thanks, Tammy. So I want to touch on this qualified small business stock treatment. I think a lot of this presentation has been slanted towards individuals, towards maybe real estate investors, manufacturing type of businesses. And when we were putting this presentation together, we were talking about whether or not this qualified small business stock treatment made sense in this presentation. And it was basically brought up around the table that like, well, we probably should because we have individual tax clients who go out and invest in companies, maybe as we describe here, small tech C corp, right? Their son's starting a company, or their daughter's friend is, has a startup, and this is something that pops up, and they it's really something that you need to factor in from the very beginning. So, what is qualified small business stock? You also hear it called Section 1202 stock. It's been around for a long time, been a planning opportunity for certain types of investors for a long time. But what it allows non-corporate taxpayers to do is exclude a portion of the gain on sale of qualified small business stock. So it's meant to encourage investment in small C corporations, largely heavy technology focused startups generally. Next slide. So some of the core eligibility requirements and core factors involved in whether or not something can qualify for the qualified small business stock treatment. Because it needs to be a domestic C corporation. Your stock has to be acquired at original issuance, right? It can't be acquired on a secondary market. The issuer has to be a qualified small business, and the business that you invested in has to maintain an active trade or business at least 80% of the time. So where this comes up is sometimes a company will get started and then maybe it'll be mothballed for a while, and then it gets some more funding and comes back to life. It's a little bit of a tripwire there in that if it's dormant for too long, that entity can basically have their QSBS status spoiled. And even if you meet the other qualifications, if it hasn't been actively pursuing that trade or business, or been actively involved in that trade or business for more than 80% of its lifetime, you would have spoiled your QSBS status. And then there's a minimum holding period requirement and a gross assets threshold that are two of the main considerations that we'll cover right here on this slide. So we have this broken out into pre or before OBBA and after, right? And what are the key changes? So the aggregate gross asset threshold before OBBA was $50 million. So once the entity had aggregate gross assets above $50 million, no future investors, no future rounds of funding would receive QSBS treatment, right? That gain cannot be excluded. So a big change after, or a big change in OBBA, was that threshold was lifted to 75 million, and it adjusts with inflation. So the inflation adjustment is something that appears in a couple of different pieces of this legislation relative to QSBS, and it didn't exist before this legislation. So it's a nice change. The required holding period prior to this new legislation, you didn't receive any exclusion if you held the stock for less than 5 years. Now there's a phase-in. Well, I think of it as a phase-in. I don't know if IRS actually called it a phase-in, but starting at year 3 of holding this qualified small business stock, you can begin to see an exclusion amount, and it's tiered up. 50% if held for 3 years, 75% if held for 4 years, and then you get your full 100% gain exclusion after 5 years of holding the QSBS qualified stock. And I won't get into the per issuer gain exclusion. I think that's a little bit complex for this conversation, but it's just another point that needs to be considered throughout. We mentioned pre and post, right? It's very important because there's no grandfather rule, right? So the stock that was acquired before the legislation retains the old treatment. New stock, new issuance after OBBA was passed receives the new treatment. You can't opt in or opt out. Basically, if you had it before the legislation was signed, you've got the old rules. If it's since the legislation, you get the new rules and the new treatment. So that's those are the key points. And the thing I want to stress here is that if you're an investor in one of these businesses, right, and you want to keep the QSBS treatment in mind, it's really your responsibility to make sure you're asking the right questions of the company, right? I think a lot of people assume, right, I'm investing in a company, they're going to have all their ducks in a row. We have companies, technology companies come to us all the time who, might be several years down the road. They've gotten angel funding, maybe seed rounds, and they've never contemplated whether or not their investors to date will be able to receive this valuable treatment. So I would say one thing to keep in mind as an investor, make sure you ask the questions related to qualified small business stock. So that was the whirlwind on qualified small business stock. We just wanted to mention the changes that would be pretty impactful. If any of you know what Section 174 is, you were probably on the lookout for the changes. So this created a problem for any company that was engaged in R&D. So important point here is that if your company was engaged in any sort of R&D, setting aside whether or not you were claiming the R&D tax credit, many of you might have heard of the R&D tax credit. This is treatment of expenses that goes above and beyond whether or not you were claiming the R&D tax credit. And it was really punitive to any company that was doing R&D in the United States, because instead of receiving current year expenses, right, you can just expense the amount as incurred in the current year. Companies were required to capitalize and amortize those expenses. So expenses incurred in the US, you had to spread it over 5 years. Foreign expenditures, you had to spread actually over 15 years. If you want to get down into the weeds, it was actually a little bit worse than that, because it was a mid-year convention on that capitalization. So the companies only received 10% of their R&D expense in the first tax period when this went into effect. It went into effect, just backing up a bit, it was a change that was made in the TCJA in 2017 that went into effect for the 2022 tax year. It was so punitive, everyone knew that it would be taken out of the tax code before it went into effect, but it ended up being in effect for 22, 23, and 24. And then we got this change in OBBA. And the change we cover here, the intricacies are not as important, right? It created a new Section 174 Cap A that enables immediate deduction of domestic R&D expenses. So I want to point out there, it's immediate deduction of domestic R&D expenditures. So foreign R&D expenditures still receive the same, are still required to have the same 15-year amortization period as they were subject to starting in 2022. So that part remained the same in OBBA. The next question then becomes, okay, starting in 2025, we're no longer required to capitalize and amortize these R&D expenditures. Well, what do I do with all the carry forward amortization amounts from the prior periods? So there was a few options there. Option one, you could just play it out. Maybe you stop capitalizing, but maybe you just want to keep all of that in place, and just let the amortization schedules run, to their conclusion. That's an option. Likely not going to be an option that many companies decide to avail themselves of, but an option nonetheless. The most common is probably option 2 here, right? Which is you're now allowed to accelerate that amortization fully in 2025, or you can spread it across 2 periods, 2025 and 2026. I think generally most of our clients are just, putting it into 2025 and going from there. There is a category, though, of eligible small business that have some additional options for how to play this out. Generally, companies that are below $31 million in gross receipts, they have the potential to go back and amend for refunds potentially, right? They can go back to 2022, 23, 24, and potentially make it so the 174 capitalization never happened, right? Receive refunds. It gets to be complicated, but there are a few cases where we've done that for clients. We expect there to be a long period that it takes companies to actually receive those refunds. We're telling clients to expect a year, hoping for better, but to expect a year. But again, there are cases where it could make sense to go back and potentially amend for refunds. And now,
Right. Thank you so much.
or sorry, Tammy, for some housekeeping.
Right. I think we've got a few minutes. I know that both Angela and Jeff have been kind of reviewing our chat to see if there's been any questions. Would you like to share those, if there were?
No, I don't think we actually had any. Let me take a look. No, maybe unless Angela can let us know. I think we're okay.
Yeah, we had two.
Okay.
Oh, okay.
Actually, Caitlin was great to hop in and answer. She did answer the question on for the second installment of the PTET payment, is there any advantage of paying before 12/31 as opposed to waiting until the deadline of 3/15? She states there still is no definitive guidance on the timing of the PTET deduction, so our general recommendation is to make the payment on or before 12/31 to take the deduction in the current year, i.e. the year the payment is made.
Right.
And then
Great advice. Thank you, Kayla.
we just had another one pop in. Another question. Does QSBS apply to an LLC choosing to be taxed as a C Corp?
Paul, would you like to address that?
I would like to if I was qualified to. Now, this is the part where I gracefully reveal to everyone that I was selected to cover this, so we weren't pinballing around, and I have some experience. But if you, I don't want to give the wrong answer here. So please, whoever that was, please reach out, or maybe we can reach out to you, and I can connect you with someone in our tech.
I'll take a shot on that.
You have that,
Again, I'm probably equally not as qualified as you are, but I believe that does not qualify. It must be a C Corp, and it must be a C Corp that meets those specific requirements. And I did have actually a comment if there are no other questions. Primarily, my world deals with situations where buyers don't buy stock, they buy assets. So a common situation here is it's got to be a good fact pattern for the QSSB. I mean, it's a great benefit, obviously, but it doesn't fit in all situations. And primarily those situations where the buyer wants to buy assets. Why does the buyer want to buy assets? Because they want a stepped up basis in the assets that they're buying, and they don't get that if they buy C corporation stock. The other one that's common in the QSBS area is, well, I have an S corp. Does an S corp qualify for a sale QSSB? My understanding is no, it does not. There are some situations where you might be able to reorganize the corporation, maybe terminate the S election, or maybe reincorporate into another corporation in order to meet the qualifications, but not for the faint of heart. You'll need to seek advice on that.
Very complicated. We've dealt with that a few times, and we can't actually deal with it either, right? That becomes, you need to engage with counsel and make sure everything's probably gets to be very complicated, which is why I mentioned from the very beginning, try to, keep that in mind. And as Tim says, all of this stuff is very case specific. And while everybody, would like the tax code to be getting simplified, in case you haven't been able to tell today and, recently, it is not simplified. So there are some definite benefits, but some big changes and not that many simplifications, if I shall go on a limb.
We actually had one more question come through, if we have a second. What is a qualified organization affected by the 60% charitable donation limitation? What exactly is the qualified organization?
Well, you need to make sure that your qualified organization is an exempt organization. And usually, actually, there is on the IRS website where you can actually look up an organization to see if it qualifies for IRS standards as being tax exempt.
501c3 needs to have a 501c3.
Exactly.
Right.
Exactly.
Actually, one other quick observation I want to make when Kaylin was talking about the PTE. So I do have some clients that don't want to mess with PTE, right? They just say, it's just kind of a pain. And if I've got numerous investors, maybe, several partners or several shareholders in an S corp, it's just not worth the hassle. Well, I would challenge you in situations where you have a significant sale of assets in that entity. Maybe you're selling property subject to California tax. That could then be an exponential benefit for you. And you'd want to then make sure that you paid attention to that June 15th deadline, which in order to play the game, Carolyn, it's still the norm to just pay the $1,000, right? If you have not previously participated in PTE, then all you got to do is pay $1,000 on June 15th, and now you're in. But if you
Yeah.
miss that, you're out. What I understand.
Well, yeah, so that $1,000 payment through 2025 is the way that you can say, I want to participate and there is no penalty. Starting in 2026, you can actually miss that $1,000
Oh,
payment
you
now,
could.
and
Okay.
instead you'll receive that 12.5% penalty on the credit. So it
So
depends on
even
how
better.
much
I mean,
you're
yeah.
underpaid by. But I would say if you only owe the $1,000, just pay the $1,000. If
Mm-hmm.
subject to that 50% of prior year California pass-through entity tax liability, that's where it may make sense to underpay and take the penalty. But for the most part, if you're
Right.
considering the election, just make the $1,000 if that's your minimum.
And if, worst case scenario, if you don't do it, it'll come back to you.
Yeah.
So
Yeah, no harm, no foul on that, because the election is made on a timely filed original return with extension. So you have a long time to make that decision whether you actually want to do it or not.
Okay, as we have no other questions, then again, I want to thank everybody for attending and encourage you, if you have any other questions, we're here to definitely help you and provide you any further assistance that you might need. Thank you so much for attending.